If I had to start retirement planning all over again, knowing everything I know now about self-directed investing, having spent the last 15 years helping tens of thousands of IRA Financial clients, what would I do differently? Whether you're in your 20s or closing in on retirement, how you invest your retirement money makes all the difference. I'm not a financial advisor, and this isn't meant to be advice, but these are the strategies I wish I had followed from day one, tailored to different life stages so you can plan smarter and retire stronger. Let's get into it. Starting with age 25 to 35, the growth phase. This is the most important time to invest for one reason. You have time. Time to take risks, time to recover from downturns, and time to let compound growth work. It's magic. If I were starting over at 25, here's how I'd build my portfolio today. I would set aside 60% of my portfolio for alternative assets. With that 60%, I would do 40% in cryptos. Yes, it's volatile, but assets like Bitcoin and Ethereum have shown real long-term upside. Inside a self-directed IRA, that growth can be tax-deferred or even tax-free with a Roth structure. You're using volatility to your advantage without giving up tax efficiency. 40% in real estate. Specifically, I go after fix and flips or short-term rentals like Airbnbs. These strategies can generate quick returns, build active income, while also creating long-term appreciation. If you're hands-on and motivated, real estate is a great way to grow fast in your 20s. 20% in precious metals. Gold and silver may not feel exciting, but they're a strong hedge against inflation and market downturns. They help balance the risk from high volatility assets like crypto and flips. Within the 40% not in alts, I would put 30% in traditional stocks, ETFs, and mutual funds, and keep 10% in cash. Not just for emergencies, but to stay nimble when opportunities pop up. You don't want all your capital locked in illiquid deals. The main idea here, you've got time and flexibility, so use a self-directed IRA to access alternative assets that can outperform the traditional market. Take smart risks early, and you give yourself a huge head start. Now, let's move into your 40s and 50s. This is when most people hit their peak earning years, but also when risk tolerance usually starts to shift. You've built some wealth. Now it's about growing smart and protecting what you've built. Here's how I'd pivot to 60% of my portfolio within alts. 30% real estate. By now, I'd lean into stable income-producing properties. Cash flow becomes more important than speculation. Remember, you can't personally benefit from the real estate you're investing in. These properties are being used to grow wealth for your retirement. 25% in private lending. At this stage, one of my favorite strategies is private lending. That can mean hard money loans, where you lend funds to real estate investors, doing flips or rehabs, typically secured by the property itself. Or it could be a promissory notes, fixed term loans with set interest payments, often to individuals, businesses, or even other investors. These generate steady, reliable monthly income, which becomes more valuable as you inch closer to retirement. And they come with less volatility than equities, especially if the loan is well structured and backed by collateral. You're not chasing home runs here. You're aiming for predictable returns in the 8 to 12% range. And if you do this inside a self-directed IRA, those returns grow tax-deferred or tax-free. It is a powerful way to turn capital into cash flow without playing the stock market. 25% in private equity. I'd still keep some exposure to private equity, but I'd be more selective than I was in my 20s or 30s. At this stage, I'm looking for more established startups, mature growth stage companies, or private funds with professional management and a solid track record. You're not investing in a friend's back of a napkin idea anymore. You want to de-risk well-run businesses that still have room to grow. And often, These funds or deals are not accessible through a traditional IRA or a brokerage firm. But with a self-directed IRA, you can invest directly and let your money compound without immediate tax consequences. It's still growth-oriented, but smarter, more calculated growth, the kind that fits better in a midlife financial strategy. 20% cryptos, I'd still keep some exposure to growth, but with a smaller allocation. And if you're self-employed, this is also a great time to consider a solo 401k plan. You get checkbook control, high contribution limits, and even the ability to borrow from yourself if needed. Not sure which structure is the right fit for you? Schedule a consultation using the link below in the description to talk with one of our experts. Finally, let's talk about age 60 and beyond. At this point, the goal shifts from growing wealth to protecting it and using it to live well. Here's the 60% of alt's retirement phase allocation that I would follow. 40% private credit or lending. This offers stable, consistent interest income. 35% real estate. Ideally, fully paid rentals or passive syndications generate monthly income with minimal effort. 15% in precious metals like gold, and just 10% in cryptos. Still a growth play, but small enough slice that it won't keep you up at night. At this stage, it's about consistency, preservation, and peace of mind. So whether you're just starting to build wealth or thinking about how to preserve it, the most important move you can make is taking action. Because no matter where you are in life, you deserve a retirement plan that works as hard as you do. What do you think about this approach? Leave your feedback in the comments below, and I'll see you in the next video.